Imagine a company that's financially robust, consistently performing well, and holding a strong position in its market.
Uh-huh.
Then, without any, direct fault of its own, its stock price suddenly plummets by a staggering 15% in a single day.
Wow.
That's precisely what happened with KTC, a major player in Thailand's credit card and personal loan industry, on June 23, 2025.
It sounds like a crisis, doesn't it?
Yeah.
Your first thought might be, what catastrophic event hit the company itself?
Right.
But here's where it gets truly intriguing. KTC's own management quickly clarified that this dramatic drop had absolutely nothing to do with their performance or core business fundamentals.
Nothing at all.
So if the company was sound, what was the real story behind this sudden significant decline?
That's the fascinating mystery we're diving into today. We're going to peel back the layers of Thailand's credit card and personal loan world, exploring the industry's dynamic landscape, the significant challenges it navigates, and the substantial support it receives from regulators. Then we'll zero in on this almost unbelievable market event that sent KTC's stock into a tailspin, uncovering what really happened and, crucially, why it matters to you.
And to give you the most complete picture, we brought together an industry analysis from SetTrade, combined with sharp insights from market news and detailed YouTube transcripts from channels like TNN and Long Tunman.
Great source.
Okay,
Yeah.
let's unpack this.
So let's set the scene. The credit and personal loan landscape in Thailand. What does the playing field look like? Who are the players? What's the oversight?
It's quite a crowded and closely watched space.
Mm-hmm.
Under the supervision of the Bank of Thailand, or BOT, and the Ministry of Finance, you'll find 8 credit card companies and a substantial 115 personal loan companies.
115, wow.
Yeah. These generally fall into 2 main groups. Commercial banks like Krung Thai Bank, which is actually KTC's major shareholder,
KTB?
and non-bank financial institutions, often simply called non-banks, like AEOTS, for example.
Got it. And what kind of economic environment are all these players operating in right now? Are there specific headwinds shaping their strategies?
They're definitely facing a complex environment. Thailand is experiencing a slow economic recovery, which impacts consumer confidence and spending.
Naturally.
And household debt remains persistently high, reaching 89.0% of GDP by September 2024.
That's huge.
It is. Beyond that, the sheer number of players means intense competition, and rising financial and operating costs are consistently squeezing, profit margins.
Given that high household debt, how directly does that impact the growth potential for credit and personal loans within this sector?
Oh, it's a direct inhibitor. Credit card and personal loans specifically now make up 8% of total household debt, which is actually up from 6-7% before 2019.
So it's grown as a proportion.
Exactly. This elevated level means consumers have less disposable income and, frankly, less capacity to take on new debt, directly slowing overall credit growth across the market.
So against that backdrop, how are outstanding loan balances performing? Are we seeing expansion or contraction?
We're certainly seeing a contraction, or at least a significant slowdown. Credit card loan outstanding saw a slight decrease of 0.3% in 2024. That was after modest growth of 3% in 2023.
So a definite cooling off.
Yes, and this largely stems from 2 key factors: stricter credit approvals being put in place,
Lenders getting tighter.
and the minimum payment increasing from 5% to 8% in early 2024, which naturally encourages higher repayments.
Right, forcing people to pay down faster. And what about personal loans? Are they following a similar trend?
Personal loans have been on a consistent downward trend since 2022. They saw a 5% drop in 2024 following a 1% slowdown in 2023.
Even steeper decline.
Yeah, and this is attributed to even tighter lending criteria from institutions, combined with strategic write-offs being employed to proactively manage asset quality.
Okay, so balances are generally shrinking. That makes sense, given the headwinds. But what about non-performing loans, or NPLs? Are those on the rise, indicating more people are struggling to pay back what they owe?
NPLs have indeed been on the rise since 2022, particularly after the COVID-19 relief measures began phasing out.
Ah, the support ending.
Right. For credit cards, NPLs were 2.6% at the end of 2024, a slight uptick from 2.5% in 2023.
Okay, small increase.
But personal loan NPLs, however, showed a surprising decrease to 3.9% in 2024, from 4.4% in 2023.
Really? Down, why?
Largely thanks to non-bank write-offs and more effective debt restructuring initiatives. They've been quite proactive there.
That's genuinely surprising that personal loan NPLs dropped while credit cards saw a slight increase.
Yeah.
Why would personal loan NPLs, with what you mentioned about lower income customer bases, still tend to be higher overall than credit card NPLs?
Well, they do remain structurally higher. Yeah.
Okay.
That's because their customer base typically has lower incomes and
Mm.
therefore, less repayment capacity. It's just a riskier segment overall.
Right. But then why do non-banks sometimes show lower NPLs than commercial banks? You'd think banks would be more conservative.
It's a great question, and there are a couple of layers to it. The intriguing part is the non-banks. They often manage to report lower NPLs than commercial banks, not by luck, but kind of by design.
How so?
Their operating systems are typically more flexible. This allows them to expedite debt restructuring and, crucially, sell off bad debts more quickly, get them off the books.
Ah,
They also employ closer, maybe more hands-on debt collection processes. Banks, on the other hand, tend to have very strict, often less nimble risk management policies, which can result in different NPL outcomes. It's really a strategic difference in how they manage distress.
that distinction between banks and non-banks on NPLs is genuinely surprising. It really makes you wonder about the adaptability of different financial structures.
It does.
Speaking of adaptability, it sounds like the Bank of Thailand has also been quite agile in responding to these challenges, constantly rolling out new measures to help debtors.
Mhm.
Can you give us a sense of their ongoing efforts and the evolution of their strategy?
Absolutely. The BOT has a clear, continuous history of implementing measures to help debtors navigate household debt. What's striking when you look at their actions from, say, 2020 through 2025 isn't just the sheer number of measures, but how they've evolved.
Okay, how has that strategy evolved over time? What were the phases?
Well, initially, back in 2020, it was immediate crisis management, right? They focused on reducing credit card minimum payments down to 5% and allowed conversion to longer-term loans.
Emergency relief.
Exactly. For personal loans, it was payment holidays, reduced installments.
Yeah.
They also brought down interest rate caps for credit cards from 18% to 16%. And for personal loans, a bigger drop from 28% down to 25%.
Okay, then what?
Then, around 2021 and 2022, they kind of pivoted to more structural long-term solutions, things like promoting refinancing and sustainable restructuring of debt, trying to fix the underlying issues.
Makes sense.
And crucially, from 2023 onwards, the emphasis has been on proactive, responsible lending, particularly targeting these persistent debt clients.
The chronic debtors.
Right. This meant allowing consolidation of credit card and personal loan debt into a single loan at a really low 5% interest rate. And get this, the original accrued interest could be waived upon full repayment.
Wow, that's a big incentive.
Huge. The aim was to help vulnerable chronic debtors clear their debt faster, typically within 5 years, while providing fairer debtor rights regarding interest and fees.
And for 2025, with that catchy phrase, you fight, we help, what's the latest in their playbook? Are they continuing that trend?
Pretty much. For 2025, the minimum credit card payment remains at 8% to maintain flexibility, alongside incentives for early debt closure. Further measures include restructuring debt before it becomes non-performing,
Proactive again.
allowing debtors to combine housing loans with other retail loans, and extending the chronic debt resolution period from 5 to 7 years. Gives people more breathing room.
Right.
They've also introduced reduced payment, reduced interest options, specifically tailored for non-banks. It's a really comprehensive approach that reflects a maturing strategy to manage systemic debt.
So the regulators are very active. Beyond them, how fierce is the competition among the players themselves in these markets? You mentioned it's crowded.
Oh, it's incredibly fierce. Both the credit card and personal loan markets are highly competitive. Operators are constantly battling for market share, launching aggressive marketing campaigns to retain existing customers and, stimulate new spending.
And I imagine in such a competitive environment, data becomes a massive advantage, right?
It absolutely does. Larger players, those with extensive customer data, have a significant competitive edge. This enables them to market far more cost-effectively and target their promotions with much greater precision than smaller competitors.
Target the right people.
Exactly. Both segments are acutely focused on attracting and retaining customers with strong asset quality, the ones most likely to repay their debts reliably. That's the golden ticket.
Let's talk market share then. How do banks and non-banks stack up against each other in the credit card space? Is it balanced?
It's fairly balanced based on outstanding loans. As of 2022, banks and non-banks hold nearly equal market shares in credit cards by that measure.
Okay.
However, non-banks currently hold a higher proportion of issued credit cards, about 64%, compared to banks' 36%.
So more cards, but maybe smaller balances.
Precisely. Interestingly, non-banks typically have a lower average loan amount per account, around 16,000 Thai baht, whereas commercial banks average about 25,000 baht.
And for personal loans, do non-banks maintain their dominance there? You mentioned that's a big focus for them.
Yes, they do. Non-banks are expected to maintain their dominant market share in personal loans, holding around 63% of total loans and a substantial 79% of accounts.
Huge share of accounts.
Yeah, and this is partly due to their strategic focus on customers with monthly incomes of 15,000 baht or less, which represents a larger customer base in Thailand.
Tapping into a bigger pool.
Right. Similar to credit cards, though, non-banks have a lower average loan amount per personal loan account at 21,000 baht, compared to commercial banks' 47,000 baht.
So how are spending trends shaping up in Thailand, especially post-COVID, and how does that relate to credit card usage? Are people spending more?
Well, private consumption expenditure is seeing growth post-COVID. That's driven by employment recovery, increased government spending, and a strong rebound in tourism. Things are picking up.
Good news overall.
Yes, but while overall consumption grew by about 4.5% in 2024, credit card spending volume increased at a slightly slower pace, around 3.0%.
Why the gap?
It suggests that while people are spending more, consumers are also becoming perhaps a bit more cautious, maybe opting for cash or debit for everyday purchases more often.
Interesting.
However, spending by high purchasing power groups remains robust. That's often fueled by attractive promotions and international transactions. Plus, government stimulus programs like Easy e-Receipt also continue to play a role in boosting domestic spending.
Okay, now let's put a spotlight on KTC and ADO and TS, two major players you mentioned earlier. How are they navigating these broader industry trends? Are they feeling the slowdown?
What's quite impressive is that both KTC and AEMTS have managed to maintain strong market shares and performance, despite the overall industry's slower loan growth. They've found ways to thrive in a challenging environment.
Tell us more about KTC's position. How does their portfolio break down, and what's driving their performance specifically?
KTC holds a very strong position. In 2024, their loan portfolio was heavily skewed towards credit cards, making up 66%, with unsecured personal loans at 29%.
Mostly cards, then.
Mostly cards. They held a 15% market share in credit cards and 6.6% in unsecured personal loans. But what's truly notable is that credit card spending volume through KTC grew by an impressive 10% in 2024.
10%, when the industry only grew 3%.
Exactly. Significantly outperforming the industry's 2.6% expansion, 3.0% was overall spending. Industry card growth was 2.6%, but KTC hit 10%.
That's huge outperformance, however.
This seems to be a direct result of their aggressive marketing strategies and their effective targeting of high-income customer groups. They know who to go after.
And in terms of asset quality and profitability, are they holding up against the industry pressures we talked about, like NPLs?
Absolutely. KTC boasts exceptionally strong asset quality. Their NPL ratio was a low 2.0% at the end of 2024, actually down from 2.2% in 2023.
Improving even.
Yes, and well below the industry average for its core segments. This reflects very strict approval policies and continuous proactive risk management. Their NPL coverage ratio is also impressively high at approximately 400%.
400%? That's a massive buffer.
It's a very robust buffer against potential bad debts. Profitability-wise, KTC's net profit increased by 1.9% to 7.39 billion THB in 2024. So despite a slowdown in interest income and higher credit and financial costs, the company effectively leveraged increased fee income and maintained disciplined operational cost control. It shows strong fundamental management.
Okay, solid performance from KTC. How does AEMTS compare, both in terms of portfolio mix and financial health?
AEMTS takes a somewhat different strategic approach. Its 2024 portfolio was primarily unsecured personal loans at 48%, with credit cards at 43%. So more weighted towards personal loans.
Right, the opposite of KTC.
Exactly. They held an 8% market share in credit cards and a larger 9% in unsecured personal loans.
And their asset quality, given their focus on maybe a slightly different customer base, how does that look?
Well, A&F's overall NPL ratio did increase. It went up to 5.9% by September 2024 from 5.0% in 2023.
Higher than KTC's 2%.
Definitely. And this is primarily due to their chosen customer base, which, as we discussed, tends to have a lower repayment capacity on average. It's a higher risk segment.
So the NPLs reflect that risk.
They do. However, they're actively managing this. The company plans to sell off bad debts in Q4 2024, which could help to slightly reduce its NPL ratio. Their NPL coverage ratio remained around 150%. Still decent coverage, but lower than KTC's.
Lower than KTC's, yes, but still provides a buffer.
And their profitability, how are they faring? Aon's net profit for the first 9 months of its fiscal year 2025 was stable at 2.2 billion THB, so flat, basically.
Okay.
While interest income did slow due to shrinking loan volumes, Aon actually has a higher interest yield than KTC.
Oh, why is that?
It reflects its larger proportion of high-interest personal loans. Personal loans just carry higher rates than credit cards generally.
Got it.
However, increased financial, operating, and credit costs, partially due to accelerated provisioning for high-risk debtors, have put pressure on its return on equity. It's worth noting, though, that non-interest income from debt sales and investment gains did help to partially offset these pressures, demonstrating their diversified income streams.
Okay, so we've laid out the groundwork, KTC, a fundamentally strong company with solid performance, outperforming the market in key areas. So it begs the question, when its stock price suddenly plummeted by that 15% on June 23, 2025, closing way down at 29.50 THB, what on earth happened? That's the real mystery we need to unravel. And we also saw this dramatic drop affecting other stocks like XPG, BEC, and TPS, right? All hitting their temporary floor limit.
Yes, that floor limit, which had actually been adjusted down from 30% to 15% because of broader market volatility concerns related to the Iran-Israel conflict at the time.
Right, so the market was already jittery.
Very jittery. And this is the crux of the matter for KTC. Their management was incredibly quick to clarify that the stock decline was not due to any issues with the company's strong fundamentals or operational performance.
They were adamant.
Completely. In fact, their Q1 revenue had just increased by 1% to 6,832 million THB, and net profit rose a healthy 3.2% to 1,861 million THB. They reiterated that their asset quality and NPL targets below 2% remained squarely on track. This wasn't a company problem.
So if the company was performing well, what was the underlying cause of such a severe and sudden market reaction? It sounds like something technical.
Exactly that. The cause was identified as technical investment factors, specifically a forced sell due to margin calls.
Okay, explain margin calls and forced selling for us.
Sure. Think of a margin account like taking out a loan from your broker to buy more shares than you could with just your own cash.
Right.
Let's say you put in 5,000 baht, the broker lends you another 5,000 baht, and suddenly you can buy 10,000 baht worth of shares.
Yeah.
Leverage, right.
Right, amplifying your buying power.
But there's a catch. Brokers set thresholds. If the stock price falls and the investor's own equity in that position, their own money tied up, drops below a certain percentage, commonly 25% in Thailand, the broker gets nervous.
Uh-oh.
And they will force sell the shares to cover their loan. It's like a security alarm for the broker, ensuring they get their money back, regardless of what the investor wants.
Okay, that makes perfect sense for what a forced sell is. But how significant was this for KTC in particular? Was a large portion of its shares involved in these margin accounts?
It was very significant. A substantial 16.3 billion% of KTC's total shares, amounting to something like 420.2 million shares, were used as collateral in margin accounts as of May 2025.
16%. That's a huge chunk of the company held on margin.
It's a very high percentage. And this wasn't unique to KTC among those affected stocks. Similarly, high percentages were seen in XPG at 13.49% and BEC at 16.02%.
And the fact that KTC, XPG, BEC, and TPS all hit their floor simultaneously strongly suggests a shared underlying trigger, doesn't it? Not just coincidence.
It absolutely does.
Yeah.
This strong correlation immediately pointed to a direct connection. These companies shared major individual shareholders. Specifically, names like Mongkol Prakachawatana and Chanthana Jirathi came up.
Ah, the shareholder link.
Exactly. Mongkol, for instance, was the second largest shareholder of KTC, holding 12.72% or about 327.46 million shares. So when these large interconnected portfolios faced margin calls, perhaps due to broader market volatility or maybe other pressures on their overall portfolios, it created a domino effect across all the stocks they held heavily on margin.
So essentially, when these major shareholders faced margin calls, maybe on multiple positions at once, it forced a massive volume of shares, including KTC, onto the market, overwhelming demand.
Precisely. When such a large volume of shares, like the 200 million KTC shares reportedly offered right at the floor price, is suddenly put up for sale due to these forced liquidations, it can completely overwhelm the market's natural buying capacity at that moment.
No buyers at that price.
If there aren't enough willing buyers, the price continues to drop rapidly until new buyers finally emerge at lower levels. This creates a severe risk for the affected investors, potentially leading to substantial losses or even putting them in debt to their brokers if the sale doesn't cover the loan.
A nightmare scenario for them.
Absolutely. And it's a stark reminder that even financially healthy companies can see their stock price absolutely hammered by external technical market forces that have nothing to do with the business itself.
It's quite a paradox then. KTC's revenue and net profit have been continuously increasing over the past 5 years. We're talking 2024 revenue hitting 27.23 billion THB and net profit 7.44 billion THB. Yet its stock price has been declining even before this plunge. It really highlights that disconnect you mentioned.
It truly does. It's a textbook example of how company fundamentals and market mechanics can operate in completely different universes sometimes. Despite KTC's robust financial health and consistent growth, the forced selling stemming from large, leveraged positions held by key shareholders created a severe pricing anomaly.
And analysts see this disconnect too.
Oh yeah. In fact, professional analysts covering KTC have an average target price of around 48.50 THB. Compare that to its June 23rd closing price of 29.50 THB.
Huge gap.
It indicates significant perceived upside. This suggests the market, or at least the analysts, know the company is fundamentally undervalued at these levels. The drop wasn't about KTC's value, but about market plumbing breaking down.
So looking ahead, wrapping things up, what's the outlook for the next 12 months for the credit card and personal loan industry in Thailand? Are we expecting continued slow growth, or might things pick up?
Well, Tria's rating, which follows this closely, expects the industry to see slow, gradual growth. That persistent, slow economic recovery and the high household debt we discussed will likely lead to even stricter and more cautious new loan approvals from institutions.
Continued caution.
Exactly. Operators will intensely prioritize maintaining loan quality and competing for that limited pool of high-quality customers. A broad, sustained economic recovery would really be the critical factor needed to re-accelerate growth significantly.
And what about asset quality, specifically NPLs? Will they continue to be a concern, or is there an expectation of improvement there?
Asset quality is actually expected to improve slightly.
Oh, okay. Why?
It's largely attributed to those stricter credit approval policies implemented over the past year. The idea is that new loans being issued are simply of better quality from the start.
Better inputs.
Right. Plus, operators are continuously enhancing their own risk management policies. And furthermore, the ongoing assistance measures from the Bank of Thailand, like keeping the 8% minimum payment rate for credit cards in 2025 and various debt restructuring programs, are expected to continue helping debtors manage their obligations.
So a combination of factors.
Yes, collectively, that should contribute to a slight improvement in overall asset quality going forward.
Okay, so today we really peeled back the layers on Thailand's dynamic credit and personal loan industry. We journeyed from understanding its competitive landscape and the extensive regulatory efforts to support debtors, all the way to unraveling that surprising market event that saw a perfectly healthy company's stock just plunge.
The profound takeaway here, I think, is how external market mechanics, like a forced sell triggered by margin calls on large shareholders, can exert such a dramatic and, frankly, disproportionate impact on a company's stock price, even when its underlying business fundamentals are exceptionally strong and healthy. It's a powerful reminder that the stock market is far more than just a reflection of balance sheets. It's a complex interplay of human behavior, leverage, technical triggers, and sometimes just sheer market structure effects.
So what does this all mean for you listening? How does understanding this intricate web of investment strategies, margin accounts, and the potential ripple effects of leverage change how you view market risk? And maybe how you assess the true value of a company, looking beyond just its direct operational performance, something to think about.